Hey everyone, so today I'm going to show you how to play volatility during earnings season. We've got earnings season kicking off week after next. I'm going to show you how I sell puts during earnings season, get in, get out before the earnings release date. And then I'm going to introduce a new concept around volatility crush, and that's how to play the position over earnings. With that, let's jump in. As always, this is not financial advice. So a lot of times you're looking at stock and you're like, how do I play this during earnings season? You can do it one of two ways. One is just sell the put prior to earnings and get out of it before the earnings release. And then one is to hold over volatility crush. I'll show you that later on in the video. But first, let's take a look at Wells Fargo. This is going to be one of the plays that we do this coming week. So if you look at right here, earnings, this is going back to 2023. This E represents all the earnings. This particular strategy, the put sales strategy, is to get in, get out before the release. So you're playing this about a week or two prior to release. And as you see, the stock doesn't move a whole lot. We're talking a couple of bucks. So I can put positions on that take advantage of the stock staying relatively flat. And I'm only doing this a week, maybe 2 weeks in advance of earnings. And then look here, some of these, it'll be flat, but then some of them, like before this earnings, look at this earnings here, I would have put this on and then immediately made money within the first day or two, and then I would have gotten out of it. So let me show you how to do this. The idea is to capture front month volatility. So volatility is very high because people are protecting their position one way or the other. They're either selling calls because they're nice and juicy and they're adding to the income of that position, or they're buying puts because they don't know what direction it's going to go. So if they're protecting their position from a downside risk. So what we're going to do is we're going to sell put spreads. We can sell naked puts, which is simply just the put itself, but that does have some risk because if it takes a bath before earnings, some bad news comes out even before earnings, it can tank and you can lose a good chunk. Whereas we'll sell put spreads, and that'll limit how much risk we're going to take. And it also enhances the return. Our max risk, really just the difference between the spread minus whatever premium we received. So here's what I look at. This is me personally. I'm doing this 2 to 3 weeks before earnings. Again, earnings kicks off week after next. So I'm going to put on several positions this coming week to be out on Friday. These are weekly options that I'm selling. I'm not going to hold over the release. So one, I've got to have good stock conviction. I have to like the stock. I'm not going to do this on stocks I don't know anything about. I'm only going to do this on stocks that I like, something that I'm familiar with. I'm going to do this on high implied volatility. So volatility's got to be through the roof. It's got to have a high market cap. So I'm not playing this on penny stocks. Usually, here's the deal. Penny stocks consider anything less than $5. Even if you're playing this on $10, one of the characteristics of options pricing is the stock price itself. So if you're doing something that's say $10, it's $10 stock and it's the position says, hey, let's open up at $9. That $9 strike might be selling for pennies, and it may not be worth it to get in by the time you pay commissions and stuff. So I typically do this for anything over $20 to $30. 30 and up is ideal. It's got to have positive earnings. I'm not going to do this on stock that doesn't have earnings. I like making money. So if the company's not making money, I'm not in it. And I'm looking at where 13-week IV is high, implied volatility, that percentile ranking has to be high. And typically I'm going to do this where the IV is way higher than historical volatility. IV is something that can't be observed. It's only observed through pricing. When I go into the position, I'm looking for high IV over historical, sometimes by 20 to 30%. The higher it is, the better for me. And then, of course, it's got to have optionality. It's got to have volume. I'm not going to do this on illiquid stocks. If you look at, and the way you can tell that is look at the bid ask. If there's a wide bid ask on your options pricing, let's say it's $1 or $2 apart, stay away from it. You want optionality and you want pricing where the bid ask spread is very close. We're talking 20 to 30 cents or even less, 5 cents. Apple is going to be very liquid. But some stocks may be a little bit less liquid, but don't do anything that's $1 or $2 wide because you're not going to get filled at the right price, and it'll definitely work against you. Here's how to set it up. When I find the stock that I like, I've got to calculate the expected move. There's 2 ways to do it. One, the hard way, which is look at the money call price and look at the money put price, add them two together, multiply it by 0.85, 85%. That is how you calculate expected move. So a lot of times you'll hear the media say, this company is expecting a 4% move. This is how they do it. The easier way to do it is a lot of brokers will already put that into your options window. So you don't have to calculate this every time. It's already done for you. Some brokers do it, and each broker is a little bit different, but I'll show you that using Thinkorswim. The strike selection, where do I put this thing? So once I have the expected move, now I'm going to look at a conservative approach or aggressive, and I've done both. If I'm going to do conservative, I'm going to go out 1.5 to 2 times the expected move. So if the expected move is $4, I'm going to go down to $6 or $8 and put my strike there. I'm going to get a little bit less premium, but it's a lot less risky at 1.5 to 2 times the expected move. If I really like the stock and I have a strong conviction that it will stay at or above the strike price, I may do just expected move times 1. So again, if the expected move is $4, I may go $4 below whatever the current stock price is. I'll enter that as my strike, collect that premium, and then move on. The expiration has to be before earnings. So we've got earnings coming up week after next. I'm going to be out this Friday. If I have a position that is, say, 2 to 3 weeks out, then I may put something on and hold it for 2 weeks. But typically, I would say 90% of my trades are 1 week long. So I'll enter it on Monday morning and I'll be out by Friday, if not before. And then the size. Size matters here. Don't do this. Don't put all your eggs in one basket. Don't do that. Do 1 to 2% of the portfolio. Less than 1% is ideal. So let's say you're dealing with a $10,000 portfolio. That means you can spend $100 on one position. So that would mean set your spread no more than $1 apart. You can still earn 10%, but you're only going to do 10% on $100. That's 1% on one position. Now, if you have 10 or 15 of these, you may allocate 10% of your portfolio on 10 different positions. And that's okay too, because you're less still 1% on each one. And a lot of large numbers, it'll still work in your favor. You collect 10, 12% on all of those. And then you just manage the position, but no more than 1%, maybe 2 if you really like the stock and you want it anyways. And then maybe I would go up a little bit higher. But yeah, portfolio sizing definitely matters. So here's what I'm looking at next week. Expiration will be next Friday. Most of them report the week after. Some of them are the week after that. So you can play this maybe twice. So one would be on expiring the 10th. And if we still like the position, let's just pick Freeport FCX, for example. If I still like it and it hasn't moved that much or it's moving up, depending on where it is next Monday, so call that the 13th, then I will put on another position and I'll be out on that on the 17th. All right, so that's how I'm going to play these. These are the implied volatilities as of today, what the current stock price is, what the strike price that my tool, this is my software I wrote. It recommends what strike price that is the most optimum for the highest ROI. And it's calculating all my returns based on selling these, what they call naked, which is just selling the put and not having any downside protection. So even with that, with these margin requirements, take a look at this. I'm getting some pretty decent returns just selling this, but I can actually enhance that by adding some downside risk protection. So let's say I have a 78 on Wells Fargo. I may go down to 76 and buy a put. I'll give up a little bit of this premium. That's okay. I'll do that because I can still get $20 on a $200, maybe $19, something like that on a $200 investment. I may do 5 or 10, 15, depending on what my conviction is. And I may spread this out. Let's say I have a $10,000 portfolio and I want to take $1,000. I'm going to spread that out. I'm going to set up $100 on each one of these. If I have a $100,000 portfolio, I may take 10,000 of that and put on all of this, but I'll distribute it. I'll make that call on Monday morning, and it's up to you. I'm just telling you how to distribute the risk. All right, so let's take a look at Wells Fargo. I want to walk into what I'm looking at from an implied volatility perspective, and I'm going to walk into how to trade it. All right, so here's Wells Fargo. Take a look. Here's historical volatility, the orange line. The white line represents the implied volatility. This is people are getting a little bit more frothy and they're buying their options. So they're paying more because earnings are coming up and they're protecting themselves. And that works out well in my favor as an options seller. Let's take a look at Schlumberger. Schlumberger, same thing, historical volatility, high IV. Take a look at FCX. We had some bad news come out on FCX, and so here's historical volatility really low. The bad news came out, and that caused historical volatility to shoot up. But let's say that wasn't there. It still means that option pricing is still very high compared to historical. So all of these make really good candidates. Now let me show you how I'm going to set the trade up in Thinkorswim. So here's Wells Fargo. And first I'm going to show how to calculate the expected move. Remember, we could take the options price, which is take your asks on both sides. So this side's your call, this side's your put. You can add them together. So say $1.54 plus 82 cents, roughly 236. And you can multiply that by 85%, and that is the expected move. Here, this broker, Thinkorswim, will put this in here for us. Every broker is going to be a little bit different. I don't calculate it every single time. This is just what I'm looking at. So I look at implied volatility. I look at what the expected move is, plus or minus 2.4, and go from there. So if I'm going to be conservative, I'm going to go 2.4 times 1.5 to 2. So we'll be looking at maybe $5 at most away from the current stock price. That's a good safe bet that the stock won't go down to that, because the expected move is only $2.44, which puts us at around $78. So that means if I was going to be conservative, I may go down to 77, 76. But look at my premiums down here. They're only $10, $6. It's not very much. So on this particular play, I could also look at Wells Fargo and just see what their chart history, and you can see that the lowest they've been is roughly in that 77 range. It looks like they're coming up to a decent support level, maybe at 78 or 79. So knowing that, I may be a little bit more aggressive and do that 1.5 or 1 times expected move. So if that's the case, $2.44, I'll come down to 78. 78, I'm going to sell the higher strike and buy the lower strike. So the way I'm going to calculate my risk is each contract is worth 100 shares. So each dollar move is $100. So that's a $200 spread just for one contract. Now I'm going to click next, take a look at my risk. $183 on a $17 investment. It's going to use up $200 worth of margin, but I'm making $17 on $200. It's about 7.5% return. I'll take that. Now that's on one position. So you're like, man, that's not very much. It's $15. But if I've got a decent sized portfolio, let me just do 10, for example. There's $157 on a $2,000 investment. Not bad, right? If I have a little bit smaller portfolio, maybe I only want to do 5 of these. I'll risk 1,000 and then I get 78. So there's my 7.5% return because I've got to take out my commissions. So 7.5% in 1 week. My maximum loss is $915 because I'm getting $85 minus the commission cost. Now I'm going to do that a bunch of times. I'm not going to do that on one stock. So we're going to diversify. We're going to diversify quite a bit. All right, we're going to take a look at Schlumberger. Here's our expected move, $1.30. Our implied volatility is very high, 40% compared to historical at 10%. This is slightly different than what we saw on the previous screen. This is because this is Thinkorswim. The other one was Interactive Brokers. I think they used 20 days for historical volatility. When I used Interactive Brokers for the other slide, it's using 30-day implied volatility. But either way, you can see that IV is high, and that's what we're doing here. We're selling IV. So I'm going to go down to 33 and 32. I'm going to protect my downside in case some really bad news comes out. Let's see how much I'm going to make on this one. $11 on a $100 investment. $100 because we got the $100 spread, and I'm making $11. If I were to say, let's just put this up to $1,000. So I'm going to go 10 spreads. And I'm going to make $110 on $1,000. Again, it's all on your portfolio size. So if you want to go higher and you want to risk 10,000, you're going to make $1,100. That's not bad, right? 10, 11%. So that's where put sales come in. I'll be doing that on several of these. What I'll do is I'm going to put a note in the comments Monday evening on which spreads that I went into. So this is what it is over the weekend, but tomorrow morning it could open up and be something completely different. So tomorrow night, what I'll do is I will put it in the YouTube comments so you can see and follow me almost in near real time what kind of spread I entered. I'll probably do this at 8:30, 8:45 Monday morning, see where it opens up and then execute. And then I will put it in the YouTube comments so you can follow along with me. And then next week, I'll report the results. The last thing I want to introduce to you, and I will go into this more next week, is volatility crush. Now, we've talked about getting out of the position before earnings. If you want to hold over earnings, you can also make money on volatility crush. So what that means is last week I traded, I think it was the week before, I traded Nike. Nike had 115% EV in the front month and like 70% in the back month, which was a week later. Now I know that both of them are going to come down, but at 115%, that was 40, 50% higher IV than the very next week. So what I did is I bought the very next week. Well, the next day it opened up at 72, 73. And so when it did that, it was only a $3 move. It was half the move that they were expecting. Guess what? That meant that all that front month volatility collapsed because I sold it. I made all that premium. And then the back month collapsed a little bit, but not as much because it still had some time left in it. And I made 15% on that play. So I'm going to show you how to do that the following week because I need earnings and I need Wells Fargo. I need those other ones. So I don't know if they'll make good candidates. I'll have to look next week when we get there, but I'll show you how to do a volatility crush play. So the whole idea is to capture the front month implied volatility and limit our risk by buying the back. And all our risk is just what we paid for the thing. So you can get into these positions, still small positions if you want. Risk $100, risk 1,000, whatever it is that you're comfortable with. I have a friend of mine that does this, and he looks at it as, let me just buy lunch. Can I get a free lunch out of this? So he'll spend $100 and he'll make 15, 20 bucks, 15, 20% on $100. He goes out, buys lunch, and he's happy. And that's the way to play this. You don't want to put your whole portfolio on a volatility crush play because it can kill you. But if you like to play a little bit, it makes a great play. I like it, and I like actually the other one is a strategic play. I like volatility crush as just a kind of a gamble, if you will. I don't like saying gamble, but because it is somewhat calculated, but I do play in that. So I will introduce that a little bit more next week. I'll show you how to actually set it up, and we'll go through it on Thinkorswim. All right, with that, I hope you enjoyed this video. Please let me know in the comments. I will be posting my results in the comments as well if you want to follow along. And if you have any questions or you want a little bit more insight, please let me know. Thank you. Have a good one.